Futures edging higher this morning ahead of a hefty earnings week. 30 minutes until the official start of trading. I'm Katie Greifeld.
And I'm Sonali Basak. Matt Miller is off today, and Bloomberg Open Interest starts right now.
Coming up, big tech on deck. Investors bracing for a busy earnings week that includes results from Tesla and from Alphabet. Meanwhile, Invesco wants to break open its QQQ piggy bank. Wall Street calling it a game-changing event, and the IPO market heating up as Figma readies what could be one of the biggest listings of the year. All of that and more coming up in the next hour. But Sonali, let's get a check on what's moving under the hood right now.
Green on the screen for the big tech firms ahead of those earnings. Huge earnings week underway. The first set of Magnificent Seven stocks reporting. Wednesday, you have Tesla and Alphabet, both stocks still down on the year, Katie, but up pre-market. Intel, too, up about 0.9% as investors await more news.
So that to come. Verizon kicking us off this morning on this earnings week, posting a surprise net loss of subscribers, but it raised its profit outlook, citing President Trump's tax bill and wireless price increases. Let's break down these results with Bloomberg Telecom reporter Kelsey Griffiths. So talk us through the fact that this was a beat and raise, but at the same time, they actually lost subscribers. Was this all due to price increases?
Yeah, so a word that you hear used to describe Verizon often is disciplined. I was just listening to the call with investors a few minutes ago, and the word discipline was coming up a lot. So I think what we're seeing here is this sort of mixed approach that Verizon is taking. They have been investing in a lot of aggressive promotions in the last several months, in the last quarter, in order to sort of catch up with some of their competitors that never stopped running promotions after the holiday season. But we're also seeing that they're not going to do that at the expense of other financials. So we did end up seeing their revenue doing really well, and we saw them raise their full year guidance on several metrics.
Well, part of that was due to what they said was favorable tax reform. When they're raising their guidance, how are investors absorbing that impact? Are they seeing this as a one-time gain, or is this something that could be more sustainable and have a ripple effect?
I think we're still hoping to hear a bit more from Verizon on what their outlook is there and how they hope to apply these favorable tax benefits. But generally, this usually looks like more capital to invest. And again, I think we're still waiting to see what they're going to do with that additional cash. We do see that Verizon has been investing in growing their fiber footprint, and they are waiting on the Frontier transaction to close, which will give them a lot more reach into that broadband market.
Kelsey, we thank you so very much. That is Bloomberg's Kelsey Griffiths. And coming up in the next hour, we're going to be joined by Verizon CEO Hans Vestberg. And it's a big earnings week for big tech and the Magnificent Seven, Alphabet and Tesla. As we've been talking about, report on Wednesday with growth tested by economic headwinds and mixed earnings results from the other big players in AI. We're going to get the details now with Bloomberg Technology co-host Caroline Hyde. And there you see it. You have these two stocks that are down year to date, one more significantly than the other.
Yes.
When it comes to CapEx, how is this going to set the stage for the rest of how investors will perceive the Mag 7 results?
Well, when you're thinking CapEx, you're likely to see Bloomberg Intelligence thinking Alphabet's going to up it, maybe 10 to 15%. This is where the margin hit comes because they're fighting for AI talent. They are making these sort of weird acqui-hires that we've just seen being done with the likes of Windsurf with Alphabet, and they're having to explain the bang for the buck. Alphabet, you're likely to get it. Google is still managing to increase the cost of ads. You're likely to see a really good, then healthy number coming from ad search in particular. AI overviews has won out really well for them, so they're likely to price more against that. So you're likely to see revenue up about 12%. You're seeing earnings per share growth for Alphabet, even though, as you see from the share price so far this year, it's been a relatively unloved stock compared to the rest of the Mag 7, because in some ways it's seen as like an AI also ran, whereas really it needs to pack the punch that it's an AI winner. Whereas Tesla, I mean, boy, we know the deliveries have been ugly.
Right. We certainly do. And I'm thinking about Miller somewhere in Italy, thinking about that as well. I will say with Alphabet, I'm interested to hear about Waymo as well. That actually has the largest footprint of any robo-taxi operator in the U.S. That's one of Tesla's big bets. I'm interested to hear any update we get on the planned expansion there.
Well, when you think to Waymo, operating profit, it's not going to be dialing us up much overall. But yes, it is managing to, in the other bets department, probably drive up revenue by about 12%. They have scaled, they've showed it work. When you look at robo-taxis, this is where the proof needs to come in. Maybe we don't care the fact that revenue is going to sink yet again. The earnings per share is going to be down about 40% yet again for Tesla. Because Elon Musk, if he come out fighting, if he can come out and say, as he already is on X, I'm sleeping there, I'm there all day, every day. This is, manic mode for him in particular. We are likely to see, therefore, maybe him galvanize his retail investor that, yes, the investments on the robo-taxi future. Remember, he's promised it not going just to Austin, where they've only got a handful, 10, 12 cars. It's going to be in San Francisco in the next month or two. They've got their new futuristic diner. Don't know if you've just seen that opening in LA, Cybertruck boxes for the win. But this is all about marketing and trying to convince people that the amount of money that he spends on his data centers and indeed on more broadly the robo-taxi push out is going to be worth it in the longer term.
I'm glad you brought up the post that he made about sleeping in the office when he doesn't have his little kids with him. He posted that on Saturday. The shares are up a little bit this morning. A lot of people posting or pointing to that post because that's what shareholders really want. They want him focused on Tesla.
They want him back in the CEO role, focused purely on this. There's also, of course, we're questioning about the money going from Peter to pay Paul. Yes, they're going to ask Tesla shareholders longer term whether they want to put money into XAI. What is the dividend of doing that? Why does Tesla shareholder want to see money put from their own money pots into the future of large language model building for XAI? Well, because it feeds into robo-taxis. It's already going to be useful within Tesla. It's ultimately about really brand Elon once again. We know how much he can shake off anxiety by just saying he's back in full force. And certainly is trying to signal that on X. The question is whether the sleeping overnight is really going to pull out some of the sales and deliveries. Juniper Y, the new Model Y, the updated Y, is likely to have done relatively well. But remember, we're going to see a bit of a pull forward because of that pullback on the tax credits that you're likely to see by the end of September. People are going to race to get their cars ahead of that 7,500 coming off. But then what about the energy business? That's been a real winner for them. We'd like to see 50% growth, but is that going to go forward now that we know that the administration and the tax and the budget bill is pulling back from those sorts of subsidies and credits?
All right, Caroline, you have a busy week ahead of you.
Whoop, whoop.
Great preview.
Remember IBM Wednesday too. It's going to be fun.
International Business Machines.
Busy
How could I
weeks.
forget? Yeah, it's we're really in the sprint season here for big tech earnings. That is Caroline Hyde. She is the co-host of Bloomberg Tech. You can catch her at 11 a.m. But speaking of Tesla, automakers also releasing results this week, and you had Stellantis posting a brutal first half with a near $3 billion net loss. Restructuring expenses, waning sales, and U.S. tariff impacts all played a role in the prelim results. Bloomberg's Craig Trudell, he leads our global autos coverage. He joins us now. And Craig, I guess it's not surprising when you think about all the different cross currents coming at automakers right now, but still, some of these numbers, specifically with Stellantis, are pretty eye-opening.
Yeah, we just talked about Tesla and the EV outlook is very mixed right now as a result of some of the changes that we're seeing the Trump administration make, and that was one of the factors that you saw. Stellantis site here is essentially doing away with some product programs related to EVs and the undermining of the fuel economy standards in the U.S. You would think on the surface that would be a positive thing for Stellantis. They sell an awful lot of big Ram pickups and Jeep SUVs, but this was a company that was trying to really transition to an electric future and having real trouble doing so. So you have a real challenge and issues with making that jump, and sort of pullback by the company that this may come as some relief a year out from now, but for the time being, this is a lot of churn in their spending, and they're going to need to do some sort of taking of charges related to money already sunk into some of these bets that they're now going to have to take off the table.
Craig, we appreciate you keeping an eye on all of it for us. That is Craig Trudell of Bloomberg News. Now, more movers on our radar. Katie, you caught this one. Block is surging after news that it will replace Hess in the S&P 500. Of course, Hess closing that merger with Chevron, and Block was down about 14% this year. It's recouping a lot of that this morning.
Yeah, big time. A nice surprise there for Block. Shares rising mightily when you think about all that passive money that might come into it. Domino's also on the rise this morning. It topped sales growth expectations. Shares up a neat 4%, and I'm really excited to talk about Invesco. Invesco, it's a little bit higher this morning. It was up 15% on Friday, Sonali. That was its best day since 2022. For a really in-the-weeds reason, it filed to turn QQQ, it's their famous tech fund, from a unit investment trust into an open-ended ETF. I swear to God, that's exciting because
I read your newsletter on this.
Thank you.
It's a Monday, but still read her Friday newsletter because it does have a lot of details on why that matters.
Yeah.
Money, a lot of money.
A lot of money, potentially hundreds of millions of dollars for Invesco that they currently don't collect. But we'll be talking about that later on in the hour. But coming up next, I'm pleased to say, Research Affiliates founder Rob Arnott, he joins us to break down a huge opportunity he sees in value stocks. This is Open Interest.
And now to high interest, a look at what's making headlines around the world. Taiwan Semiconductor's market value closed above $1 trillion for the first time last week, driven by robust artificial intelligence demand. The stock surge reflects growing investor confidence that the world's top chipmaker will ride the AI boom to even greater dominance. And the biopharmaceutical company Sarepta is refusing to pause shipments of its medicine for a deadly muscle-wasting disease, despite a request from the FDA. 2 teenage boys died of acute liver failure in recent months after taking the treatment. Sarepta has lost about $8.5 billion in value since March 18th, when the first patient death was reported. And Microsoft servers have been hit by a large-scale cyber attack, with hackers exploiting a security loophole in the company's SharePoint systems. The Washington Post is reporting that the breach affected U.S. federal and state agencies, universities, and energy companies. And Katie, you do see Microsoft shares down almost 0.7% pre-market.
Yeah, a little bit of a drop there in Microsoft. We'll continue to follow that story. But let's zoom out a little bit and take a look at the broader universe, because our next guest says that historically cheap value stocks are screaming opportunity as growth stocks get the spotlight. Rob Arnott of Research Affiliates says that, quote, if the value is dead narrative is even slightly wrong, value should perform brilliantly in the coming decade. Exactly the same argument can be applied for U.S. versus non-U.S. stocks and for U.S. large cap versus small cap stocks. I'm pleased to say that Rob joins us at the desk now. It's great to see you in person.
Wonderful to see you.
So I know you like asymmetrical bets. When it comes to value versus growth, it seems like, as you said, even this being slightly wrong would translate into big opportunity for you.
Yeah, the prices are set based on narratives. The narrative is that the Magnificent Seven will alter our world beyond recognition in the years ahead, that these companies will own the future, and that the owners of these companies have nothing but prosperity ahead. Narratives have the advantage of being largely right. These companies are going to rock our future. Shareholders in these companies are participating in that revolutionary change, but it's already in the price. And so that means if any of the seven were to fall short of expectations, the consequences can be unpleasant. This is how the dot-com bubble burst. The folks who coined the expression Magnificent Seven clearly never saw the movie. 4 of the 7 are dead at the end of the movie. And so do I want to pick which 4 of the 7 aren't going to be stellar in the coming decade? No, I do not. I want to look elsewhere for opportunity. And this is an opportunity-rich environment. I've been called a perma-bear. I'm a bull on things that are cheap and a bear on things that are frothy.
Well, let's talk about where value is working. We were looking at this chart this morning, and I thought I was hallucinating until Sonali reminded me that we're looking at the small cap universe. If you compare Russell 1000, we have the Russell 1000 value index. It should be the Russell 2000 value index versus the Russell 2000 growth index over the past several years. We'll get the chart up. But anyway, in the small cap universe, you do have value stocks outperforming growth stocks mightily over the past 5 years. And I think a lot of people would be surprised by that. But does that just come down to the facts that you don't have those Magnificent Seven tech stocks or anything like them when it comes to the small cap universe?
The narrative takes hold when companies get noticed, and they rarely get noticed when they're small cap. So what we find right now is that Russell growth, for instance, is at nearly twice the valuation multiples of Russell value. Russell large cap growth is nearly 3 times the valuation multiples of Russell small cap value. And these spreads are at historic extremes. So looking at large cap growth versus small cap value, the spread is wider than it was at the top of the dot-com bubble. It's wider than it was at the trough of the COVID value meltdown in the summer of 2020. These valuation spreads are huge. Now the narrative is, forget value, these companies are toast, or many of them are. Here's a simple fact a lot of your viewers will find utterly shocking. The earnings for Russell 1000 growth have grown over the last century to date by 1% per year faster than the earnings for Russell value. 1%.
So what does this mean? Does it say more about the small cap universe than it does say anything about value and growth? Because to Katie's point earlier, you do see the S&P 500 growth index really outpacing that of value for, let's say, just, you know, I guess you could say normal sized stocks now, not just the small sized ones. And so are people worried about quality right now when it comes to things that are more leveraged, maybe less profitable?
We're doing some work on growth that I think is going to be making some big waves. People think you're a value guy. What are you focused on growth? No, we're fundamentals people. Fundamental index is based on fundamentals. Can you do the same thing with growth? Turns out, yes, you can. If you choose companies based on the rate of growth and then weight them based on the dollar magnitude of that growth, you wind up with a better growth index. And it turns out that, you know, some of these frothy growth stocks don't have spectacular 5-year earnings growth. It's pretty good, but it's not spectacular. And if you choose companies based on their underpinnings of growth, what is the 5-year growth rate in earnings, in sales, in spending on R&D? You wind up with a better growth index. But that's not where the screaming bargains are. The screaming bargains are in non-U.S. stocks relative to U.S., non-U.S. value in particular, emerging markets value in particular, and small cap value versus large cap growth. Our work on developing capital markets expectations shows a 10-year outlook for small cap value of 8% per annum better than large cap growth.
Well, Rob, let's talk a little bit about just U.S. versus the rest of the world, because it's interesting to hear you say that that's still a bargain to go outside the U.S. Because we've seen quite an outperformance this year, and it feels like the first half of this year, people were saying this is a false dawn, it's not going to last, the U.S. is going to come back, and now you have a lot of folks saying, all right, well, I missed the rally. It seems like you're saying there's still room to run.
Oh, there's so much room to run. The room to run in large cap growth is a little doubtful. I mean, these companies have to exceed lofty expectations in order to outperform the market. And all you have to do outside of the U.S. and in U.S. small cap and U.S. value is exceed rather bleak expectations. Here's another fun factoid. I mentioned that Russell 1000 growth had earnings that were only slightly faster than Russell 1000 value over the century to date. Russell 1000 growth dividends have grown slower than Russell 1000 value dividends. So while the stocks of value have done terribly for quite a few years, the companies have done fine. Better than fine. They've done better than the growth stocks.
Speaking of waiting for value to catch up, when you pull up FTW on the Bloomberg terminal, these are factors to watch. You can see momentum outperforming much of what's out there. I'm wondering who you could blame for the momentum. Is it the retail traders flooding the market? Is it the quant investors who are trading off the momentum? Is it the passive funds that are driving flows?
Yes, yes, and yes. All three of the above. Indexation itself has taken on a life of its own. It's half of the total market capitalization. Do a little thought experiment. Say it's 80% of the market. Index funds aren't passive. They do trade. 5% per year is the average turnover. That means they're 95% passive, 5% active. What's that active slice look like? They're buying frothy companies that are trading at
How do you
lofty
fight
multiples. You don't fight it, you look for the opportunities that it creates. Because it's it's happening. Money's flowing in. When they have to buy a stock, it will be a frothy, high multiple company. And it'll replace a deeply out of favor, unloved company. That was the basis for our next concept. And if you go back historically, what you find is that the frothy companies then slightly underperform until they settle in to market-like valuations, and the unloved tend to bounce back. So looking for opportunities that are created by indexation can be very big. Now, thought experiment. 80% of the market is indexed. This could be the case in 8 or 10 years. That 5% turnover means 4 out of 80. For the other side of the market, it means 4 out of 20. That means that active managers have to be willing to sell 20% of what they own to the index funds, creating just stratospheric valuation spreads for the companies being added versus the companies being dropped. You can even do a thought experiment where it exceeds 100% of the plausible float, and in that case, the go-to price for the additions becomes infinite, and the go-to price for the sales becomes 0. Fascinating.
Yeah, we're going to noodle on that and so much more. You're sticking with us through the opening bell, I'm pleased to say, so don't go anywhere. We have much more coming up next. This is Bloomberg. All right, minutes away from the opening bell. Here's your setup. The S&P 500 slightly higher. Could today be another record? We'll talk through all of the action at the open coming up next. Don't go anywhere. Rob Arnott is back with us. This is Open Interest. All right, we are moments away from the official start of trading on this Monday morning. Welcome back to Bloomberg Open Interest. I'm Katie Greifeld. We know it's a consequential week when it comes to earnings. Verizon actually started off on a good note this week with a beat and raise quarter, but so did the financials last week. So did Netflix last week, and we saw the reaction there. This market has a very, very high bar. So it's all about the single stock stories this week, which is what we're going to be focused on bringing you. The bells are ringing over at the NASDAQ, over at the New York Stock Exchange. Maybe we get another record high on the S&P 500 today. Let's talk a little bit about some of the components that could get us there.
Yeah, if we get there, big tech might help. We have, of course, Tesla, Alphabet earnings later this week. Huge earnings week underway. Another big one next week, too. But Wednesday is when you see these two. Of course, they are both down on the year. But Google, Alphabet, trying to break back into green territory for the year, up about more than 1.2% at the market open. Tesla up more than 2%. Intel also up, Katie, before those earnings.
Those are the names that we need to behave this week. We'll, of course, bring you all the action there. Let's talk a little bit more about Verizon, though. It posted a surprise net loss of subscribers, but it raised its profit outlook, citing Trump's tax bill and its wireless price increases. Shares currently up about 3% or so. A reminder, we'll be speaking with the CEO at about 10:10 a.m. today. You don't want to miss that, but you don't want to miss this either. We're back with Research Affiliates Chairman and Founder Rob Arnott. And Rob, let's talk about earnings season a little bit and the reaction function that we've seen so far, because I mentioned the big banks last week posting really impressive numbers, not exactly seeing the reward. Then you saw Netflix coming out with really strong numbers, falling 5% on Friday. It seems like this market is a lot tougher than maybe it has been in seasons past.
This is what happens when you get a frothy bull market. And I'm on record suggesting that this is a bubble. Bubbles last until they don't. And so this is going to be interesting to see how it plays out. One other element that I think is really important, our CEO, Chris Brightman, has come out with a number of very interesting pieces that show that stimulus doesn't stimulate, that when it comes to fiscal stimulus, a lot of that comes back into corporate earnings. So every $1 trillion of incremental deficit spending leads to hundreds of billions of dollars of incremental corporate earnings. Just fascinating. And so the stimulus doesn't stimulate the economy. it does stimulate earnings, and it does stimulate, think of it as a fire hydrant open on a city street. The people who in the homes don't get any of the water. The people with buckets near the fire hydrants get all the water. Well, who's the people with the fire hydrants? Financial services and corporate America on the profit side.
So who benefits the most? Because you look at Verizon directly citing favorable tax reform as they increase their guidance. Are there places you're looking to see where that one big beautiful bill is going to be impacting corporate America the most?
We haven't drilled down to that. I wish I had a good answer for you on that. Broadly, it'll impact corporate earnings in a big, beautiful way, and that can keep bubbles going longer. We saw that through the whole period of monetary ease with zero interest rates, where the zero interest rates sure didn't stimulate economic growth. Economic growth was kind of sluggish that decade, but it sure stimulated capital markets. And it's not a healthy form of incremental growth if it's rewarding share prices and not the broad public. So that's the big issue. That's the big divide.
Well, let's talk about bubbles a little bit more, because I feel like we're all kind of familiar with how bubbles form. You get some stimulus stimulating the capital markets. You get investors falling in love with a theme such as AI. But how do bubbles pop? What is the typical catalyst when you look across history?
Firstly, catalysts are, by definition, a surprise.
That's true. I was hoping you could just tell us.
It's still a fun parlor game to try to guess what they can be. Second, thought experiment. What were the catalysts that caused the dot-com bubble to burst in March of 2000? I have yet to hear a really powerful argument for what it was. Maybe stock options coming up for expiration for redemption of shares, that sort of thing. But realistically, the catalyst can be almost anything. One catalyst can be earnings growing a little slower than expected. Another can be the economy faltering. Another can be a liquidity crisis in which people need access to their money. And all of a sudden, those massive inflows into index funds become massive outflows because people need access to cash. What's the most liquid asset they've got? Their index funds.
Perhaps a catalyst, too, could be the Fed chair getting fired in some manner.
Well, that's where I was going to go next also. This whole idea of the pressure that President Trump has been putting on Fed Chair Powell. You think about liquid assets, U.S. bonds being among the most liquid of them. What's the perfect hedge? Do you recommend hedges right now? And is there anything in your portfolio that suggests that your clients are flocking to them?
Well, I think one question, and you've touched on this with some of your other guests today, is what's the next move for the Fed? And realistically, historically, the natural yield on short-term money is about 1% real. Okay, so if inflation is running 2.5, that means 3.5 is the go-to rate. One of your earlier guests also said that they thought that the 10-year ought to be at 5. Well, 3.5 on short money, 5 on 10-year money is a perfectly normal yield curve. And so moving in that direction is probably where we're headed. Now, I say where we're headed because, like gravity, the movement of interest rates towards a natural rate is entirely normal. It can be forestalled by enough pressure from central control. Japan's been practicing yield curve management for a couple of decades. Look where it's got them. Their macroeconomic growth has been negligible. So it's not the right thing to do, but it's an easy thing to do.
All right, Rob, we got to leave it there. Great to see you. Always appreciate you being so generous with your time. That is Rob Arnott. He is the chairman and founder of Research Affiliates. Let's get a check on this rally right now. This stock market in general, you're taking a look at the S&P 500 up about 0.3%. And I have some good news for you, and that's that breadth looks pretty good at this exact moment. You take a look at the gainers relative to the losers in the index, more than 300 names in the green, just under 200 in the red. And it's a lot of names that you would want to see leading gains right now. Apple higher, Meta, Alphabet ahead of earnings. Then you have Broadcom and Amazon in there as well. Tesla, too, ahead of earnings. That's going to be one of the more fun reports this week. But take a look at the downside, and you could get a little bit nervous about today's action because you have NVIDIA and Microsoft trading places right now for the biggest loser on a points basis. We're talking about small moves overall, but when we're talking about trillions of dollars in market cap, certainly those names have a big effect. So let's take a look at the sector levels and what the breakdown looks there as well. Again, more green than red. Up in the top, you have communication services. The biggest mover there is Verizon after its beat and raise quarter. The CEO coming up on open interest next hour. You take a look at the bottom, industrials, healthcare, and energy. Some of your small gainer or losers right now, Sonali.
And coming up next, we're going to talk about what you had identified a little earlier, Invesco wanting to reclassify QQQ so it could reap the benefits of one of the world's most popular ETFs. There's millions at stake for this ETF. We're going to talk about the details next. This is Bloomberg Open Interest.
Welcome back to Open Interest. Let's take a look at this market right now and the rally that's underway. The S&P 500 up about 0.3%. You can see a lot of strength is coming from big tech with the NASDAQ 100 higher by about 0.5% right now. We'll see if that holds through the big earnings week that we have ahead with Tesla and Alphabet taking the stage this week. And shout out to the small caps as well. The Russell 2000 up about 0.5%. It's time now for our top calls. Some of the analyst action in focus this morning. And first up, Dollar Tree getting upgraded to a buy over at Barclays. The firm says that it's positioned to benefit from a trade down by consumers, which will only accelerate. Next up, you have Morgan Stanley upgrading Pinterest and Etsy, citing improving macroeconomic trends. The analyst also cites Pinterest's attractive valuation. Take a look at shares right now, higher by about 2.5%. And finally, I am so excited for this. Invesco getting upgraded to a buy over at TD Cowen. The firm is calling its move to unlock fee revenue from the QQQ ETF a, quote, game-changing event. So let's discuss this news now with Bloomberg Intelligence financials analyst Neil Sipes. And Neil, I feel like this requires some explanation. So the QQQ ETF, it's actually a unit investment trust, which I swear to God is interesting. They're filing to turn it into an open-ended ETF, and that actually has huge consequences for Invesco because in its current format, Invesco doesn't actually earn any fee revenue from this enormous fund.
Yeah, and that's right. And I think that's why you mentioned the enormous fund. That's why this is such a meaningful story here. For the past 20 plus years of the fund's existence, Invesco has, charged a 20 basis point expense ratio. All those fees are effectively pass-through fees onto third parties. One caveat there is 6 basis points of that 20 goes to a marketing budget for Invesco. So they really lean on that to sort of broaden the brand of Invesco. But in terms of a management fee, advisory fee, actual top-line support, pretty much zero here. So when you talk about the fund with, I think, north of $350 billion in assets, they're looking to sort of convert this into an ETF, charging a slightly lower 18 basis point fee rate. And so we'll kind of have to see what it looks like overall. But I mean, when you run the rough math, it's obviously quite meaningful to the business. We calculate about 7% of net revenue is what they can generate if they sort of net out fees that are similar to the QQQM, which is actually sort of the clone ETF product that they rolled out about 5 years ago.
Right. That was their answer to this dynamic where, okay, QQQ is very popular and it's just growing, but we don't make any money. Let's launch sort of a baby version of it. I want to talk about the specifics of what this could mean for Invesco a little bit more because I did the napkin math, 20 basis points on $355 billion in assets. That translates into more than $700 million in annual revenue that they're missing out on. We won't know the exact revenue breakdown, how much of that goes to the index licensing, et cetera, but in terms of the boost that could give to the bottom line, just expand on your calculations a little bit more. Yeah,
and so I think when we look at QQQM, again, which is active in the marketplace as an ETF, it's about $50 billion versus the $350 billion in the unit investment trust. So when we look at that, about half of the 15 basis points is what they're netting to the top line. So if you kind of do that rough math, again, the earnings accretion is pretty meaningful here. And so I think going forward, it's going to be the question of how much do they retain some of that marketing budget. Obviously, that's going to eat into it a little bit, but it really does two things for Invesco. One, it meaningfully steps up that earnings sort of run rate as a normalized business. And it really steps up the organic growth potential, right? Because these are non-management fee earning flows that they have today. It's a product that's been growing double digits over the past probably 5 to 10 years, whatever time frame you look at. So that's going to be well received in the market. You saw it Friday with the 15% increase in the stock. In a world where traditional asset management is a little bit out of vogue, the ETFs still continue to produce the growth.
That's where I was going to go next. If you look at the stock of Invesco versus BlackRock this year, it's pretty interesting. You see it at double the pace. It's rising right now. It's up more than 15%. BlackRock is up less than 8%. BlackRock, of course, is a much bigger company. So the Qs, they've become synonymous with Invesco in a lot of ways. How important is it for them to capture this fee revenue?
I mean, I think it's pretty important, especially when you think about Invesco in the context of someone like BlackRock, where you look at the price to earnings multiples there, it's about half of BlackRock. And really the story with Invesco has been a pretty painful but necessary transition in asset management from the higher fee active products to the lower fee passive. And what we've really seen over the past 2 years with Invesco is a meaningful sort of re-rating in that organic growth. They've actually flipped to positive flows, some of the strongest in the industry. A lot of that is coming from the ETF and index franchise. So when you all of a sudden put their biggest fund and the most meaningful product that they have in the marketplace back into that franchise in terms of revenue generation, it's a meaningful story.
It's worth pointing out, too, that Invesco reports earnings tomorrow. Their call is at 9 a.m. So if you're not watching Open Interest, I would imagine that this is going to be a hot topic. Let's talk about how this actually goes through, because this is a proposal right now. They filed a proxy statement to shareholders on Thursday of last week. They're holding a special meeting on October 24th. They need a quorum of more than 50% of the holders of outstanding voting shares. That is a very tall hurdle to clear when you think about how many tens of thousands of shareholders the Qs have.
Yeah, and so they may be leaning on some third parties to help garner that support. I guess two things of note. One is the QQQ as it stands today, 20 basis point expense ratio. Through this proposal, they want to reduce it to 18 basis points. So that in some worlds should generate some shareholder interest, right? When you're lowering fees, that'll usually make your shareholders smile there. So that should help generate some interest. But, you know, I think we know that the QQQ has a pretty sizable retail investor holding as well. So sort of garnering the support of a lot of smaller retail investors, you may sort of need a lot of outreach and maybe need some third-party support there. But again, I think, you know, over time, we'll certainly be watching this. It's sort of a unique story in the space right now. We'll have to see if others follow suit and sort of follow how this proceeds. But certainly if it goes through, it's definitely a net positive.
Yeah, absolutely. It'll be fascinating to see how this one develops. I do want to pull up that table once again, the most profitable ETF. So it's ironic that the Qs are at the top and Invesco doesn't actually see much of that profit. You also have SPY up there as well, which is fascinating because this is in the same situation as the Qs. This is a unit investment trust, meaning that State Street itself doesn't really see much of that $577 million in annual fee revenue. Neil, I know you don't cover State Street, so I won't ask you about it, but really great insight here. Stay close. That is Neil Sipes of Bloomberg Intelligence. And don't miss ETF IQ today at noon right here on Bloomberg Television. State Street's Anna Paglia and Double Line's Jeffrey Sherman join the show. Now coming up, Figma and some of its investors are seeking to raise over $1 billion in an IPO. We'll bring you the details here next. This is Open Interest. Welcome back to Open Interest. Let's get a check on this rally because we have gains extending right now. If you take a look at the S&P 500, now higher by about 0.4%. We are above 6,300 on that index. And you have big tech really leading the way with the NASDAQ 100 higher by about 0.6%. We know that it is a busy week when it comes to earnings. A lot of big tech names reporting. You take a look at what has reported so far to my left here. You had Domino's earlier this morning. It was higher. Now it's lower. Verizon really holding on to its gains right now. And then you have some of the big tech names. Tesla up on the earnings stage. It's higher right now, too, but it's coming up this week. And we'll see if it follows the path of Stellantis, which was reporting some pretty hefty charges when it comes to some of those tariff impacts. Sonali.
Yeah, and in other news, we have IPO news coming as well. So companies not yet hitting the New York Stock Exchange or NYSE, but pretty close. Figma is one of them. The company and some of their investors are looking to raise just over $1 billion in an initial public offering. The software company has filed for a listing, which could see it valued at close to $13.6 billion. For more, we're joined by Bloomberg Equities Capital Markets reporter Anthony Hughes, and that $13.6 billion valuation is below the $20 billion that it could have gotten in a sale to Adobe. What does this say about valuations for the darlings that are about to hit the market?
Yeah, well, I think it's interesting because once you add in restricted stock units and options and the equivalent of options and the like, the valuation will be a bit higher than that, more like 16 billion, 16.5 billion. And I think over the next week or so, as the roadshow goes on, and this is the deal that's going to be pricing next week, next Wednesday, the July 30. There's going to be likely to be a lot of demand because this is a fairly scarce asset in a company that's growing 40% plus. The software sector hasn't been as busy in the last few years as it was in, say, 21. So the situation we have here is that this is somewhat of this is a big event for the software industry in the sense because this is an application software company that's going public, and there hasn't been very many of them in recent years, and this is going to be getting a pretty sporty valuation. Some of the software IPOs that we've seen in recent years have come at more like sort of around 10 times sales, whereas this one's going to be leaning a bit more on the valuation. And I think, even though these numbers we're throwing around today are based on the terms that they've launched this morning, I think, it could expand over the next week. Certainly the company will be hoping so.
So circle that date on your calendar, next Wednesday, July 30th. It's interesting to see just the pace pick up this summer. There's been no summer slump when it comes to the IPO market, and I still don't have a good sense of what is driving that. Is that we're past peak uncertainty? Is it just that traders and companies are tired of waiting so long to come out of that pipeline?
Yeah, well, it's been an interesting year in terms of the narrative for the IPO market because while it's been a fairly positive environment, we've seen some really strong outcomes, some strong debuts, particularly Circle, which was early last month. But we did have a big gap there in April where there were no IPOs, and we've had these disruptions associated with the spikes in volatility around the tariffs and the like. But overall, the environment's been very strong, and when IPOs have come to the market, the IPOs that have come have been quite well received and heavily oversubscribed. And I think people are generally positive about the outlook, particularly after Labor Day. But normally the summer can slow down a bit. But here we've got a bit of a flurry of deals that's going to happen between, say, now and maybe the next 3 weeks, and then we'll have a break for August. But we're going to have 4 companies go public this week, 4 sizable companies, and then next week we'll have Figma, and we'll have another one too, so another one or two maybe.
Also, Katie, bullish that crypto exchange has also filed a lot of SPACs as well. So this is a market that is absorbing this while it can.
I'm glad you defined it because I was going to say, didn't you just launch the show and
I know.
going public as well?
I know, different going public.
Yeah, true. Anthony, great reporting. You're going to be very busy over the next week or so. That is Anthony Hughes of Bloomberg. And coming up in the next hour, we're joined by BlackRock's Gargi Chaudhuri. She will be talking to us about earnings expectations, and then really excited too for our conversation with the CEO of Verizon.
Yeah, we'll also speak to Senator Dave McCormick after that big AI summit in Pennsylvania. Stick with us. This is Bloomberg Open Interest. And we are 30 minutes into the trading day. We are green on the screen and record highs for the S&P 500, NASDAQ 100, too, I believe, flirting with fresh records. Welcome to Bloomberg Open Interest. I'm Sonali Basak.
And I'm Katie Greifeld. Matt Miller is off today. And it's interesting, right? It really feels like this week is purely about earnings. I say that, and of course, we're going to get some dramatic trade headlines. That's just how it works. But a lot of focus purely on the fundamentals and what these executives are actually saying about the environment.
And coming up, big tech investors are looking for those earnings this week. Tesla, Alphabet report on Wednesday. And of course, big tech continues on into next week, Katie.
And the perfect hedge emerges as Wall Street works out how to play President Trump versus Jerome Powell.
And Senator David McCormick is joining us to talk President Trump's recent visit and the promise of Pennsylvania as an energy hub.
And last hour, we asked Research Affiliates Chairman Rob Arnott where to find value.
The screaming bargains are in non-U.S. stocks relative to U.S., non-U.S. value in particular, emerging markets value in particular, and small cap value versus large cap growth. Our work on developing capital markets expectations shows a 10-year outlook for small cap value of 8% per annum better than large cap growth.
Joining us now, BlackRock's chief investment and portfolio strategist for the Americas, Gargi Chaudhuri. And you listened to Rob Arnott talking about value versus growth. That is definitely something that you would hear Rob Arnott talk about. But I also want to ask you what people are looking for with valuations where they are, with stocks at record highs once again. Is the catch-up trade reliable? The names that have fallen behind.
Good morning. It's so lovely to be here. Thank you for having me. So I was listening to the previous speaker talk about value versus growth, and this is something that's been coming up from our clients a lot as well. And I'd say a couple of things. Number one, performance follows earnings for the most part. And if we've, obviously a lot of earnings season to come so far. But what we saw, especially last season, was that it was growth that really led the S&P higher. And even if we look at the price action over the last 2 weeks, it is some of the AI names that are moving stocks higher. So I think all eyes should continue to focus on AI and the CapEx spending. And I think that is what's going to move, if at all, the next leg of the market higher. If we are disappointed in some of the AI CapEx news, maybe we get a brief pullback. But if we continue to see some of the companies continue to spend on AI, I think it's going to be growth leading the markets, and particularly AI-named growth companies leading the markets higher.
Spread makes the market, Katie.
I have heard that one before. Let's talk about the earnings reaction function a little bit more. You touched on it a little bit, and we've got to focus on CapEx here. There's a really interesting Bloomberg Intelligence stat that you take a look at how the market is treating companies that missed expectations. They're getting punished by the most in nearly 3 years. So this is a very, very unforgiving market as we head really into the heart of earnings season.
Yeah, and I think one of the reasons that we might be a little bit more unforgiving when the earnings are missed is think about how low the bar for earnings season broadly this quarter is. If we think back to where we were in Q1 with a 12.5%, 13% EPS growth down to, call it average, about 4.5%. I think that the bar is low, so expectations are most companies will meet or exceed that bar meaningfully on revenues. And then I think the other point here is that this is a very ripe environment, given that valuations are have been lofty for a while. They're fully valued for a while. There are many other reasons that are driving the markets. It's not just about valuations. It's certainly about technicals as well as fundamentals. But when valuations are where they are, I think any kind of misses on expectations can be more punishing. This makes sense for where we are in this cycle.
So there is another narrative here that a lot of investors have concerns about how it will continue to spill over into markets, and that is President Trump's relationship to Fed Chair Jerome Powell, that on-again, off-again threat about whether he could let him go. And you do see investors starting to place at least more and more bets around this threat. You have people looking at a sell-off in the 10-year. Today's not that day, by the way. Today we have a buying in the longer end, but then you also have bets against the dollar. You have bets on the steepener. What do you make of these Powell hedges and how reliable they are?
Absolutely. So a couple of things that everyone is looking to recognize and price into their portfolio. The first one is the central bank independence as being one of the few free lunches out there. The central bank being the central bank not just of the US, but of the world. And we want that independence associated with everything, certainly our financial assets. So it makes sense to think about where investors are adding some hedges. And some of them are ones that we've been talking about for a while. It's not related to these latest headlines from last week. And I think thinking about a weaker US dollar, thinking about the ramifications of that into international markets, adding to things like IQLT, which is our preferred expression in the international markets, thinking about gold as a diversification source as many of the foreign countries diversify their reserves away from the dollar into gold, adding that to your portfolio. We've been talking about these things for a very long time. And then lastly, obviously, it's about treasury prices.
Right.
And that's something that we saw on Thursday with the yield curve steepening. If central bank independence is threatened, I think we're likely to see the yield curve continue to steepen and more inflation premium coming into the market. So buy some inflation-linked bonds and stay away from the really long end of the curve. That's what we're telling investors to do.
Interesting. So are you saying that the odds are high enough that that's now an investable theme? It's time to go into some of those assets, some of those funds, because this is higher than 50%?
No, I don't think it's about that. I think it's about building a diversified portfolio. Some of these were recommendations that we would have told investors to take into consideration in their portfolio anyway. Mm-hmm. These are not things that we're recommending investors do just because of the threat of central bank independence going away. You should, at this juncture, given all of the tariff news, have inflation protection, especially in the very front end of the curve, in your portfolio, given where real yields are. You should consider international in your portfolio, given the outperformance we've seen and the valuation differences. And you should think about the front end for income and not so much the long end. Mm-hmm. And on top of that, we've just got one other catalyst.
So how seriously do you take the threat to central bank independence today? We have seen the push-pull between the president and the Fed chair. However, there are a lot of people that would say that there is more than one person who's putting in that vote, that there could be a series of checks and balances to the system. Where do you stand on that spectrum of this conversation?
Yeah, so like I mentioned before, I think it's, for investors, for everyone listening right now, the idea that we have central bank independence is really important to be investing in U.S. markets. And I think that's something that's playing out over and over again. I'm not particularly concerned that that's gone away. I'm really not. But I also think that some of these diversifying strategies that we are talking about right now will behoove your portfolio in any case. And investors across the U.S. are quite underweight international, given what we see in advisor portfolios. So allocating to international does make sense, regardless of your view of any of the other factors. Similarly, inflation-linked bonds in portfolios. I know, Katie, you spend a lot of time looking at ETF flows. If you look at inflation-linked as an asset class, that hasn't necessarily been gathering the inflows, even though the performance has been spectacular in the very front end of the curve. So adding that to your portfolio, looking at something like an STIP, which gives you that very front end of real rates, make a lot of sense.
Yeah, it's one of those rare situations where flows haven't been following performance, inflation.
And therein lies the opportunity.
There you go. Let's talk a little bit more before we let you go on the U.S. versus the rest of the world, because that's a conversation we also had with Rob Arnott. And what I said an hour ago, and I'll say it again, is that, okay, in the beginning of the year, people said this isn't going to last. This is a false dawn, and this will fade. And now you have a lot of folks saying, okay, we're already seeing this magnitude of outperformance. There can't be that much more room left to run. It sounds like you're also saying, no, that's flawed logic.
So the three themes that we think about when we think about international diversification. So the first one starts from the portfolio context. When we talk to our clients and then when we look at their portfolio holdings, what we're finding is that most advisors are underweight international and overweight small cap. Now, when we take that one step further and look at during periods of sell-offs in the market, in the S&P 500, small caps actually underperformed international. So international outperforms small caps. So for those investors who, unlike what our recommendation is, which is very much about large cap and quality. For those investors who haven't had that view and have had a huge bias to small caps, we think it might be a good time to move away from that into international. So it's a diversification and a portfolio question. And then lastly, I will say that we still continue to believe that the US dollar may continue to decline. And in that case, not only are you getting US companies, especially in the tech space, that are going to benefit, but obviously international as well.
Gargi, we thank you so much for joining us here on set this Monday morning. That is BlackRock's Gargi Chaudhuri. Looking forward to more of your views throughout the rest of earnings season. The micro and the macro are colliding. Speaking of the micro, let's get a look at some of the single stocks moving this hour. We're going to bring in Bloomberg's cross-asset reporter, Denitsa Sekova. We're looking at Block. I think this is interesting. Katie pointed it out this morning. You have another crypto-linked stock here that is causing some waves in the broader index.
Yes, just incredible story. Block is joining S&P 500. We're not talking about the actual quarterly rebalances we're seeing. Obviously, Hess is being acquired, so Block is joining. But it's something interesting we've seen, especially with Strategy, is that as those companies join the indices and they're passively both, that's adding a big boost. And we recently had a story how Vanguard is one of the biggest holders for Strategy, but this is a big case here. Block, of course, formerly known as Square, is offering peer-to-peer transfers. They have crypto exposure. They have consumer loans. So they're tapping into all of those different themes that have been doing quite well. The stock is actually down year to date, so the jump today is much needed boost to the company. The company is integrating Bitcoin. Of course, Jack Dorsey has been a supporter for a very long time. But overall, this is a major milestone for them, and it opens a whole new world of benchmark, passive, and active investing going forward.
Yeah, so we'll see Block trying to claw out of that year-to-date hold. We only have about 30 seconds left with you, but talk to me about what's going on with Domino's, because it was actually a pretty good quarter. You wouldn't know it by looking at the shares right now.
Yes, it was a great story. It was coming off stuffed crust. The CEO was talking about it in a call. Great success. Posted high revenue in the second quarter, but it actually missed second quarter profit expectations. So I assume some of the drop we're seeing is that pre-market we saw a big jump. That says the stock is still up 9% year to date. A lot of optimism, a lot of new features. It's also enrolled in DoorDash and the big deliveries, so that's a big boost there.
Denitsa, thank you for joining us this morning. That is Denitsa Sekova. I've been meaning to talk to you about Domino's all morning, Katie, because I do love Domino's. I think Matt Miller was the one that wasn't very into it.
Yeah, no, he is not here today, though, so
exactly.
That's fine.
So we take over. Anyways, coming up next, a strong second quarter powering Verizon higher today. We're going to speak with the CEO, Hans Vestberg, next. Stick with us for that conversation. This is Bloomberg Open Interest. And we welcome now our Bloomberg television audience and radio listeners. Verizon stock rising after beating revenue estimates and raising its profit outlook. Joining us now, Verizon CEO Hans Vestberg. Question about your revenue guidance here and the beat that you have posted so far. How much of a role did the recent price increases play in the quarter's performance?
No, if you look at the quarter, I mean, and actually the last 4 quarters, our strategy is working. We have a lot of vectors of growth all the way from our broadband, fixed wireless access, our step-ups. Prepaid is growing, and then we have our adjacent services with perks and all of that. So all of them are actually contributing. And then the last, I would say, 3-4 quarters have also been very good and disciplined on our cost levels. So we get the leverage. So our EBITDA was $12.8 billion, a growth of 4%. So we raised the guidance both for EBITDA, EPS, and free cash flow. All of them sort of coming from generation of good financials. But it's based on the customer offerings we have built over the last year. That is really resonating with the market, either on broadband or wireless. And for all customers, we're serving all customers in the United States, all the way from the governmental or federal customers to large enterprise, SMBs, and consumers. So that's what you see right now resonating with the financials. But ultimately, it's about having the right offerings for our customers.
Well, let's talk about those cost levers a little bit more when it comes to wireless, because, okay, you had a net loss of 51,000 monthly wireless phone subscribers in the period. Analysts had been expecting a gain, actually, of about 12,000. At the same time, you did have those wireless price increases go through. How many more times can you pull that lever and continue to raise prices?
I think we had a price increase on consumer postpaid in the first quarter that has been lingering to the second quarter. I never disclosed my commercial strategies going forward, but I think we have a good value, we have a good proposition, and we have an enormous good value on the consumer side. But you cannot forget our business side, where enterprise and SMBs are continuing the growth for us, both in wireless and broadband. Overall, in the quarter, we had more than 300,000 new customers coming in at the same time as we gain in efficiency.
So what does this mean for the progress and the path to restoring growth in phone subscribers?
So if you look at the quarter again, we had 300,000 new customers coming in on wireless and broadband. We are building the network once, that's a strategy, and then getting as many profitable connections on top of it. So this quarter was 300,000 again. So that's why we are growing our business at the moment. And we had the first half year, our service revenue, which we are measured on, is growing 2.4%. The overall revenue was growing 5% this quarter, way over 34 billion, was driven by a lot of upgrades on phones. So we have growth in our business right now, and we're getting leverage on that because we have 4% growth on EBITDA, we have 6% growth on EPS. So clearly that is falling through, and the efficiency works. So we are very focused on the growth. We have many vectors of growth, but also we are very financially disciplined how we spend that money to grow that customer base.
Curious to talk a little bit here about what you're seeing in the big, beautiful bill, because you cited favorable tax reform as one of the things to be optimistic about. So walk us through specifically what benefits you see there from tax reform and how that translates into the next quarter, into the year ahead, for example.
Yeah, so when it comes to the bill that was passed, I mean, there was one piece that is very important for Verizon. That's, of course, the depreciation we can do directly on our capital investment. That have this year an impact of $1.5 billion to $2 billion on our free cash flow. So it's significant. Together with our operation, our cash flow from operation that is improving, that's why we increased our guidance with almost $2 billion in the quarter compared to the financial guidance we had from the beginning of the year. So that's one piece of the bill. The other piece of the bill is, of course, that the government wants to auction out spectrum again. Verizon is in a great position of spectrum today, but over the time, as we as a country want to be the most digitalized country in the world, spectrum needs to come out for 6G and other technologies going forward. So we are very encouraged to see that as well. It's going to take time before that spectrum comes out for auction, but it's good that the government are thinking long term in this area.
On tax impacts in particular, your earnings are perhaps the more obvious first set of glaring results that show you a benefit immediately. But is this kind of a one-time benefit, or do you see some sort of ripple effect that comes out of that big, beautiful bill for you and maybe even the rest of corporate America, frankly?
So the tax benefit has not impacted our financials yet. That's going to be in the second half and then going into next year because it's a perpetual sort of benefit we have. So that will continue. But I think for us, we are very disciplined with our capital. We already increased our capital for 2025 compared to 2024. Now we have our Frontier acquisition pending. We're waiting for the last approvals here. When that comes in, of course, we're going to make a holistic view how we're going to do capital allocation going forward. But always we put first priority in the business. Number two, we have increased our dividend 18 consecutive years, and we're going to put our board in a position to do that. And then we're paying down our debt to get our leverage ratio. And after that, including Frontier, we're also going to come to buybacks. We're going to package that in the next couple of months and talk to the market how we see about capital allocation and the benefits of incorporating Frontier when that's approved.
Well, Hans, keep in touch as you make progress there. Great to get some time with you on what I know is a busy morning. That is Hans Vestberg of Verizon. Still ahead on Open Interest, making PA an AI innovation hub. We'll speak with Senator Dave McCormick about President Trump's visit and the promise of Pennsylvania as that AI hub. This is Open Interest. Welcome back to Open Interest. It's time now for High Interest, to look at what's making headlines around the world. And we start with Japan's prime minister vowing to remain in his job after his ruling coalition suffered a bruising defeat in upper house elections. Now, this setback could derail delicate trade negotiations with the U.S. just weeks before that August deadline. Meanwhile, Treasury Secretary Scott Bessent said earlier today that the institution of the Federal Reserve and whether or not it has been successful must be examined. This comes as President Trump escalates pressure on the central bank, and the president is also denying a Wall Street Journal report that suggested that Bessent talked him out of firing Fed Chair Jerome Powell. New York City and New Jersey officials are projecting a $3.3 billion economic boost to the region from hosting the FIFA World Cup next year. 8 matches will be held at MetLife Stadium in New Jersey. That's expected to bring in over 1.2 million fans and tourists to the region, so traffic will be a nightmare, Sonali.
We're used to traffic in the region, aren't we, Katie? But, you know, traffic in the market today looks positive. So we're looking at an S&P 500 that has been up on the morning. We have hit fresh record highs. We are well above 63.30 at the moment. We are led higher by those tech giants: Apple, Alphabet, Broadcom, Meta being your biggest points gainer, PepsiCo, EQT, Eli Lilly, GE among your biggest decliners. Tesla has been fluctuating throughout the course of the morning. Remember, Tesla and Alphabet both reporting on Wednesday. Big moment for the market, Katie, as we look to sectors as well as we head into this week. Communication services led higher as well because of those tech giants. Materials also higher. Broad-based gains that we're looking at this morning.
President Trump's 50% tariff on copper is set to go into effect next week. And now the race is on for U.S. companies to restart the nation's copper production. Ivanhoe Electric is planning to build the first copper mine in the U.S. in more than a decade. It hopes to start selling copper cathodes to manufacturers before the end of 2028. Joining us now to discuss is Taylor Melvin. He is the company's president and CEO. Taylor, great to have you with us. To steal a line from the Wall Street Journal, the end of 2028, that is a blink of an eye when it comes to mining terms. So what gives you the confidence that you'll be able to spin up and actually start producing by the end of 2028?
Well, good morning, and thanks for having me. It certainly is a quick timetable for our project. Our Santa Cruz Copper Project in Arizona, which is located about an hour south of Phoenix, Arizona, is located entirely on private land. And so what that means is our permitting authorities are the state of Arizona, Pinal County, and the city of Casa Grande. Being on private land is a huge advantage for copper development projects in the United States. And that's largely what allows us to be in position to start initial construction as soon as the beginning of next year, which, as you pointed out, would allow us to produce first copper before the end of 2028.
What does this mean in terms of how much copper we're able to extract out of this country? At the end of the day, there's a lot of concern that with the copper tariffs you're seeing, that there's going to be a limitation, that there will be a drive higher in prices because the U.S. is not known to or might not have the capacity to produce everything we need.
Well, we certainly have seen a run up in prices in the U.S. on the anticipation of these tariffs, and we'll wait and see what the actual rate is, what the duration of the tariffs will be. But I think the important thing to note here is this is an administration that is exhibiting strong support for domestic production of critical metals, including copper, and they're pointing out the importance of securing our supply chain security for the production of these metals domestically. So our project in the United States, owned by a U.S. company, has a very high-grade underground copper deposit that's capable of producing pure copper metal for U.S. consumers. Importantly, we're not going to be producing copper concentrate. We have very limited capacity in the U.S. to smelt copper concentrate, and a lot of that production has to be sent offshore to be turned into copper metal. Our project is going to produce about 72,000 metric tons of copper per year during its first 15 years of a 23-year mine life. That's almost 160 million pounds of copper cathode ready for use by U.S. consumers.
Well, you bring up smelting, and that's where I want to go next, because there's at least two parts here, because there's the copper that you bring up out of the ground, and then there's smelting. And as your notes point out, we only have 2 domestic primary smelting operations. The U.S. lacks the capacity to process the copper that it actually mines here, so it often sends it to other countries. It's smelted there, and then it comes back. And that American mined but foreign smelted copper is subject to tariffs, Taylor. Do you think that that setup makes sense? Have you been talking to the administration about that and whether or not that dynamic should continue?
We certainly have been in conversations with different agencies of the U.S. government, and we're very appreciative of their support of our industry. You do point out a very critical dynamic in the copper industry, and all of the policies that this administration is pursuing is intended to promote U.S. production of critical metals, including copper. And you've really pointed out the key advantage for our project, in that we do have the capability to produce pure copper metal that will not be sent offshore to be smelted. So we're in a great position to have a high-grade project with a very low-cost structure. We're going to produce copper at about $1.32 per pound. And so certainly at today's copper prices, that's a huge margin for that production. And our project is certainly economic at prices that are much lower than today's prices. So being able to produce copper metal for the U.S. market is a huge advantage.
So you're located in Arizona in particular, pretty close, not too far from where Rio Tinto's copper mine project is also popping up. Can you speak to the competition that might be forming as Rio Tinto enters the United States in a bigger way?
You know, to meet the demands that we need in the United States and globally, we need to bring a lot of new copper projects online. And certainly Resolution is a huge project that has the ability to produce a lot of copper in the future. But that project has a much different profile than our project. I'll let Rio Tinto and BHP, who are the owners of that project, comment on its progress. But you know, we're certainly advantaged with our project to be located on private land. And so we need a whole lot more than just one project to meet future demand that's being driven by growth and, you know, rebuilding and improving our electric grid, the artificial intelligence industry and the prolific growth of AI applications that need data centers, that need more electricity. So we need a whole lot more copper to meet future demand.
Yeah, and it certainly feels like the stars are aligning for businesses such as yours. Taylor, great to get some time with you this morning. That is Taylor Melvin of Ivanhoe Electric. Those shares up about 54% year to date as we count down to August 1st, and maybe some hefty tariffs on copper. Let's take a check at the broader markets right now, because you can see we're building on our rally when it comes to the S&P 500. We didn't quite get to a record close on Friday. Perhaps we'll get there today, because Sonali, right now you have the S&P 500 up by about 0.5% with big tech in the lead. And
I'm interested also in the bond market, where you have a 6 basis point move lower in the 10-year, despite all that rhetoric around the President Trump and Fed Chair Powell, the tit for tat we're seeing there, the bond market getting a little bit of relief today.
Yeah, you're certainly not seeing worries about destabilization when it comes to the long end of the curve, and everyone keeps telling us that's the place where you would want to look. Keep an eye on the long end as that heats up.
And big tech powering the market higher. And speaking of technology, we're going to go soon to Pennsylvania because, of course, that AI summit had just taken place. And we welcome now our Bloomberg television and radio audiences. President Trump was in Pittsburgh last week at a summit that was led by Republican Senator Dave McCormick. Dozens of top executives attended the event with the goal of making the Keystone State a hotbed for energy and AI innovation. Joining us now to talk about the initiative is Senator Dave McCormick himself. Now, you had so many companies there, of course, many large investors, both investing in data centers as well as these big hyperscalers themselves, and also commitments to jobs. What was said outside of the public eye a little bit, Senator? Can you tell us about the jobs that might be created in the state, maybe above and beyond the things you've heard from GE Vernova, for example, Google, with dollars that they would be putting into the state? What else can happen?
Well, good morning. Thanks for having me. It was really an historic day. You know, right after I won the election, I talked to President Trump, and I suggested that it'd be great for him to come to Pittsburgh, where we could talk about the crossroads of the AI revolution and the energy revolution. Pittsburgh and Pennsylvania is really at the center of both revolutions. We have the second largest energy production in the country. We have bountiful natural gas, fourth largest reserves in the world, incredible skilled workforce that you just referred to, incredible technology universities. Carnegie Mellon is where we hosted this. And the president agreed to do it, but honestly, it exceeded my expectation. We had CEOs from the major investment firms. Blackstone made a $25 billion commitment. We had big energy CEOs. We had the hyperscalers, as you said. We had global investors, the CEO of GIC, the CEO of Mubadala, the CEO of the Canadian Pension Plan. all to think about how Pennsylvania can be at the forefront of this incredible revolution. We had $92 billion of investment that was announced, about $36 billion in data centers, about $50 billion in energy infrastructure and production. That's transmission, that's distribution, that's a transition from coal to natural gas in a number of places. So this is the beginning of something very special. And I guess this is absolutely going to create tens of thousands of construction jobs, thousands of permanent jobs. But I think the most important thing was not the announcements of the day, but 150 media people that were there that allowed us to tell Pennsylvania's story. This is just the beginning. The Emirates was there, United Arab Emirates, Khaldoon Al Bamarek from the UAE. My wife and I, Dina, we had just been in the Emirates. We had talked to Sheikh Mohammed, the Crown Prince, or the leader, and he had mentioned the commitment he had made to President Trump to invest $1.4 trillion in the United States over the next 10 years. Think about that, $140 billion a year. So the $92 billion is a lot, but it's just the beginning.
Senator, there's the money involved, there are the firms that would be involved in building more AI infrastructure, but then there are the rules and the regulations. What is your office doing to tear down red tape when it comes to energy infrastructure, and how might that be mimicked across the country? You're looking at Governor Kathy Hochul here in New York as well, looking to make nuclear power a bigger part of the story. That follows the 3 Mile Island announcements last year.
Right.
What's going to change?
Well, there needs to be permitting reform at both the national level, the federal level, as well as the state level. And the thing about this incredible moment is this should be a bipartisan moment. So I did an event the night before the summit with Senator Fetterman in front of 300 energy executives. Governor Josh Shapiro was at the summit. He and I did a panel together with Amazon, which has committed $20 billion to Pennsylvania. That's in addition to the $92 billion. So we need permitting reform at both the federal level and at the state level. And listen, politics is politics. We're going to have lots of disagreements with Democrats as Republicans, but energy dominance and taking leadership in Pennsylvania at the forefront of these incredible changes, I hope that's something we can agree on. And permitting reform is the key. I'm on the Energy Committee. I'm the chairman of the Energy Subcommittee. And when we get back from the August recess, we're going to turn to permitting reform.
Let's keep talking about nuclear, because if you take a look into the future, I mean, how does this landscape actually develop? Do you see modular nuclear reactors going up around the country? What are you doing specifically to bring them to Pennsylvania, perhaps?
Yeah, I do. And one of the great announcements at the summit was the iconic Westinghouse Corporation announced that it was going to build 10 nuclear reactors over the next 10 years. And that's huge. That's the rebirth of nuclear power in the United States. And of course, there's all sorts of new technologies around modular reactors. The CEO of Westinghouse, when he was on the CEO panel that we had in Pittsburgh, said that one of the main reasons for that was the executive order that President Trump had put in place. This is one dimension of energy dominance to embrace nuclear power. I've sponsored legislation with Senator Coons, a Democrat from Delaware, on the need to embrace nuclear power. So it's got to be a mind shift. Permitting reform is a critical part of it. It's a longer cycle to get these nuclear reactors up and running. But what's already happening in Pennsylvania, we have a huge installed base. Constellation, the biggest nuclear provider in the country. 3 Mile Island was just, a deal was just done with Microsoft to create power for Microsoft data centers. We've got the Limerick plant, which is going to get refurbished. So there's two dimensions, or maybe three dimensions. There's refurbishment of existing facilities to lengthen their lifespan. There's the traditional big reactors that are going to be built in Pennsylvania. Mm-hmm. And then I think there's next generation modular reactors, which offer real opportunity.
So, Senator, energy, of course, as evidenced by the fact that we're talking about nuclear, it's a broad church here. But then you consider wind, you consider solar, maybe some of those clean energy sectors that it seems like President Trump has really been de-emphasizing, if you want to call it that. Why not take a holistic approach here?
Well, listen, he has said, and I've said, that I support all forms of energy. So I'm in favor. One of the deals that was announced was the deal between Brookfield and Google on refurbishing some of the hydro facilities in Pennsylvania. So I embrace all forms. I think where the difference is that President Biden had hundreds of billions of dollars of subsidies for some of these clean energy alternatives. And President Trump was opposed to that, and I was opposed to that because it was one of the drivers of inflation. We should let the market rule. Great innovations happening with the market. And the problem with wind and solar, it can be part of the answer, but it's very intermittent compared to the baseline power capacity of natural gas, of nuclear power, of coal. And so to meet the energy demand we have about an expectation of about tripling the demand for energy over the next 15 years. We're going to need strong, consistent baseload power. So wind and solar can contribute, but it's never going to be the core of the answer.
Senator, before you were the senator of the great state of Pennsylvania, where I also went to school myself, you were also the CEO of what was long been the world's largest hedge fund. I'd love for you to weigh in here on what's happening between the White House and the Federal Reserve, because a lot of market watchers are looking at this and questioning what this means for the central bank's credibility. What would you like to see happen ultimately? And do you also think that the Fed's credibility is at stake here?
Well, I think President Trump has made clear that he has no plan or expectation of firing Chairman Powell. I think it's a long-held tradition that presidents often critique the conduct of the Fed chair, so that's not new behavior. The president's going to have a chance to put his imprint on the Federal Reserve with 3 appointments in 2026, 2 Fed governors and the chairman, and I think he's going to do that. And listen, what's happening in the economy is really noteworthy here. I think the worries about an inflationary pulse as a result of tariffs are not coming to fruition, so I'm hopeful that we're going to have a rate cut in the future. And if you're President Trump, think about it this way. It's like driving the economy is like driving an aircraft carrier. All the great things that are happening, energy dominance, deregulation, the big, beautiful bill and what it means for permanent tax cuts, pro-growth, economic policy. The one thing that's still a struggle for working families is high interest rates. And so the president's very focused on delivering on his promises to working families, as am I. And that's why interest rates are such a big deal. It's hard to finance a home. We've got home prices that are way up in Pennsylvania. So this is all part of making sure that the president delivers on his agenda. And I'm confident that with the policies we're putting in place, that's going to happen.
Senator David McCormick of Pennsylvania, we thank you so much for joining us here on Bloomberg Open Interest. Thank you very much. Now, coming up, we're going to talk more about Powell and how Wall Street is looking to hedge against any potential risk between the White House and the Federal Reserve. More on that next. Stick with us. This is Bloomberg Open Interest. Now, Wall Street is on the hunt for the perfect hedge for if President Trump fires the Fed chair, Jerome Powell. The president has made no secret that he would like to fire Powell, and strategists are now trying to figure out how to position themselves. For more, we are joined by Bloomberg's Washington bureau chief, Peggy Collins, and we should say the foot has been taken off the pedal for now, right, for a minute here, because you do see a lot of threats, but then a cooling off of the threats and then a layering on of the threats again. How do you think about how this is playing out, particularly after the reports over the weekend about Scott Bessent, so the Treasury Secretary's involvement in taking that foot off the pedal as well?
So, Sonali, I think no doubt last week it ratcheted up here in terms of the intensity and pressure and attacks around Fed Chair Powell and whether or not the Fed is going to cut interest rates as President Donald Trump would like him to do. And also in the backdrop is this question over whether or not Powell would step down from the Fed entirely in May 2026 when his Fed chair is up, or stay on the board until his board seat is up in 2028, which would be a diversion from what's usual. So I think all of those forces are in play. And also you have this issue of the renovation of the Fed building, which Pulte has taken scrutiny over. So I think last week, no doubt the attacks intensified, but the president said also that he didn't expect to fire him unless there was an issue of fraud for cause. And as you noted, Treasury Secretary Bessent is one of the people who keeps trying to pull the president back and say, hey, this wouldn't be good for markets.
Right. So for cause and, of course, the renovation are related here. And Peggy, just a common sense approach. I think a lot of people struggle to understand how you could spend $2.5 billion on a building, on a renovation.
Well, that's true, Katie. It is a mind-boggling number. But our colleague Kristen Capps here in the D.C. Bureau did a story over the weekend that really looked at and put into context some of the renovations of buildings as old as the Fed. It hasn't been renovated since the 1930s fully. And one of the big issues here is that they are trying to build and renovate underground, a parking garage turning into office buildings because of some of the height caps in Washington, D.C., different from New York, where you can build skyscrapers. You can't down here. And D.C., as you may know, was formerly a swamp. So that is one of the big issues here. Another was that when the Fed started on this project, steel costs and inflation took off. So some of the cost estimates then took on more weight over time. The president and his allies say it's lavish. Powell has said it's not. It needs to be renovated. So there's a back and forth there on that.
Wasn't this renovation well known about, though, Peggy? I mean, how is this even being used as a credible argument against the Fed chair?
Well, I think one of the things is that Congress has been asked to investigate it. Powell has also opened up an investigation himself through the IG at the Fed to say, hey, we think we did the right thing, taking steps even to the point of going to a planning committee for approvals that we didn't by law have to do. So I think this is really about the tension between the president wanting to have interest rates lowered. Because if you think about it, there's really three pillars going on right now in the U.S. economy. There's the tax bill, which the president got through. There's the trade and tariffs, which are still very uncertain in terms of how they will move through the economy. So far, we haven't seen as big of an impact as some people thought. And then there's interest rates, which a lot of Americans are still feeling the pinch of. And so the president really wants that third pillar to go his way. And Powell right now is saying he still wants to see the impact of tariffs through the summer before he'll do that. So one of the things to think about is the Fed meeting next week. That's what we're looking towards. They will meet on Tuesday and Wednesday with the decision on Wednesday and the presser after. Right now, we aren't expecting the Fed to cut based on economists throughout the market, but we could see some significant dissents.
Right. Yeah, I'm sure Jerome Powell is really excited and looking forward to that press conference. Peggy, great to get some time with you. That is Peggy Collins. She is Bloomberg's Washington bureau chief. It's a really interesting world where bond investors actually have to care about the underground garage at the Federal Reserve if it means that Jerome Powell is potentially on the live, but I digress. There's things moving in the equity market.
It's pretty crazy. You're looking at things really turning around here for some companies, at least. Stellantis reversing losses. They had posted a preliminary first half loss of nearly $3 billion. Yet the stock now, Katie, in the green. Maybe the loss is like biting the bullet a little bit here. Perhaps things get better a little bit from here after things got really tough.
Yeah, some interesting logic working through the trade there. Invesco, TSMC also higher today. Much more markets coverage coming up next. This is Open Interest.
It's a market still powering higher, and of course, we have earnings season underway. Coming up tomorrow, we have Fifth Third CEO Tim Spence talking about regional banks on the heels of his earnings, and famed venture capitalist Alan Patricof. Stick with us through the close today. Of course, we're looking at fresh records, but that's all for us today.